Okay, let's unpack this. Imagine you're standing at the edge of a vast ocean of information specifically. The intricate world of corporate tax can feel a bit overwhelming, right? But what if you had a map, a compass, and maybe two seasoned navigators to guide you through, pointing out all the hidden treasures and, the crucial landmarks? That's exactly what we're doing in today's deep dive. We've taken the definitive how-to guide for corporate tax returns in the UAE, the Corporate Tax Guide, CTGTTXR1. And our mission is basically to extract the most important nuggets of knowledge for you. We're trying to give you a shortcut to being truly well-informed about the essentials without the info overload.
Yeah, and it's important to understand that this guide, it isn't just some, dry legal document. It's specifically designed to walk a taxable person through the actual filing process on the AmeriTax platform. It's all rooted in the UAE's Federal Decree Law No. 47 of 2022, with provisions applying to tax periods starting on or after June 1st, 2023.
Right. So for someone like a business owner or maybe just a curious learner trying to get up to speed, what's the core implication of this self-assessment process in the AmeriTax system?
Well, the core implication is that UAE corporate tax runs on a self-assessment model, meaning you, as the taxable person, you're responsible for calculating and reporting your own tax liability. It's all done online through AmeriTax, and there's a pretty firm 9-month deadline from the end of your tax period. What's particularly clever, I think, is how the system actually tailors the return to your specific circumstances. It kind of guides you through key decisions you'll need to make.
Okay, let's uncover a particularly insightful aspect. You mentioned tailoring. Imagine a tax form that literally changes based on who you are. This guide shows how AmeriTax pre-populates and customizes your return.
That's exactly right. And a critical point to clarify is who exactly qualifies as a taxable person in the UAE's corporate tax landscape. Because it's broader than many might assume. It includes juridical persons, that's your typical companies or corporate entities, but also natural persons conducting business, so individuals, maybe sole proprietors, freelancers, whose business income hits the threshold. And importantly, qualifying free zone persons, those businesses in specific free zones, meeting strict criteria for special tax benefits. Each of these categories sees a slightly different set of questions tailored to them on AmeriTax.
So if you're an individual, say, running a business, the system asks about your turnover, but it clearly excludes things like salary, personal investments.
Right, or real estate investment income.
Correct. And it also digs into your tax residency, double taxation agreements, that sort of thing.
Yeah.
But if you're a company, a juridical person, they're interested in whether you're part of an MNE, a multinational enterprise group.
Exactly, which means a total consolidated group revenue of AED 3.15 billion or more. That's, pretty substantial.
Huge, yeah. So these details really shape the return you actually see and fill out.
They do. They significantly shape it.
Okay, so we've sort of plotted our initial coordinates, understood the tax identity. Now the map seems to lead us to this crucial layer of flexibility, the elections. You're not just like passively reporting numbers. You're actively making strategic choices. These can fundamentally alter your tax liability.
Yeah, these elections are pivotal. Absolutely pivotal, because they dictate how certain financial events are treated for tax, often offering efficiencies or administrative relief, take the realization basis election, for businesses using accrual accounting.
Where you record income when earned, not when cash changes hands.
Precisely. This election lets them delay recognizing gains and losses until they're actually realized, like when an asset is sold, not just when its value changes on paper. And this is a significant choice, generally irrevocable, made in the first tax period.
Right, a big decision early on. Yeah. And for those just starting under this new regime, you mentioned transitional rules elections.
Yes. If you owned specific assets, qualifying financial assets, property, intangibles before your first tax period, and they were on your books at historical cost, you can elect to adjust your taxable income, basically to exclude the pre-corporate tax gains or losses on those assets.
So it's like drawing a line in the sand, making sure you're not taxed on value created before the law came in.
Exactly. It's about fairness in the transition. And then there's another really impactful one, particularly for smaller businesses, small business relief.
Okay.
Think of it this way. If you're a resident person, you're not part of an MNE group, not a qualifying free zone person. And crucially, your revenue is AED 3 million or less in the current and all previous tax periods. You can elect to be treated as having no taxable income. Pay no corporate tax for that period.
Wow. Okay, so zero tax.
Zero tax for that period. It's an annual election, and it's designed to significantly cut the admin burden for smaller growing businesses. Let them focus on, operations.
That sounds incredibly helpful. Now, beyond small business relief, the guide also outlines options for bigger moves, like within groups or during restructuring.
Yes, absolutely. Transfers within a qualifying group. This allows asset transfers between related companies in the group with no immediate tax hit. No gain or loss recognized for tax purposes then. This applies to all future capital asset transfers within that qualifying group and is generally irrevocable. It encourages streamlined internal management.
Okay, so that sets an ongoing policy.
Yeah.
And business restructuring relief, is that different?
It is slightly different in application. It also eliminates the corporate tax impact of certain specific restructuring transactions, like mergers or demergers. But the key distinction, as you said, is that qualifying group relief is ongoing for future transfers, while business restructuring relief applies transaction by transaction.
Got it. So one is a policy, the other's per event.
You could put it that way, yeah. And finally, for those operating internationally, there's the foreign permanent establishment exemption. A resident person can make this annual election. It's a potentially huge strategic advantage.
How so?
It effectively stops double taxation on foreign branch income. You can exclude the income and expenses of all your foreign branches from your UAE taxable income calculation, provided those foreign branches, those FPEs, are already subject to corporate tax abroad at a rate of at least 9%.
So it streamlines the global tax position. Makes the UAE quite attractive as a base.
Definitely. It reinforces its position as a hub for international business.
Okay, so we've identified ourselves, made these big strategic elections, set the course. Now the map leads us into the real core, doesn't it? Transforming your accounting income into taxable income. This sounds like where the precision really comes in with all these adjustments, the guide details.
It is. Accounting income is really just the starting point. The law mandates specific adjustments. For instance, if you use the equity method for accounting for investments.
That's where you own a big chunk of another company and record a share of its profit, even if you haven't received a dividend.
Exactly. The guide makes a key distinction here for tax. You have to disregard that share of earnings or losses from your income statement, except for any actual dividends that were declared and received. It simplifies things by focusing more on sort of realized cash flows for tax.
Okay. And for our listeners who might be individuals, partners, in an unincorporated partnership that's treated as its own taxable person.
Right. If the partnership itself is the taxable person, then your share as an individual partner of that partnership's accounting income or loss is disregarded in your personal taxable income calculation.
Well, that's double counting, essentially.
Correct. Avoids taxing the same income twice. Now, a really significant area of adjustment comes under exempt income.
Yeah.
Dividends and profit distributions you receive from another UAE resident person are always exempt from corporate tax. No conditions attached. Simple.
Straightforward enough.
But for income from a participating interest, think dividends or capital gains from a significant investment, usually in a foreign company, there are strict conditions for that exemption. Typically, you need to hold at least 5% ownership or have an acquisition cost of AED 4 million. And crucially, the foreign entity itself must be subject to tax abroad at a rate of at least 9%.
So more hoops to jump through for foreign participation exemption.
Definitely. And you need to be aware of potential clawback rules, too. If conditions like holding the investment for at least 12 months aren't met later on, the exemption could be reversed.
Right. Okay. Then there are the things you can't subtract, the non-deductible expenditures. What's on that list?
Well, this list includes a detail that might catch some businesses off guard. Only 50% of entertainment expenses are deductible.
Only half. That seems specific.
It is. And it's a strategic point. Businesses need to realize that half these costs won't reduce their taxable income. It might impact budgets, how they view entertainment as a tool. It's a clear signal from the tax authority about what they see as directly necessary versus maybe more discretionary spending.
Makes sense. What else is non-deductible?
Things like charitable donations, but only to non-qualifying public benefit entities. Fines, penalties, bribes, obviously, and perhaps logically, the corporate tax itself. You can't deduct the tax payment when calculating the income subject to that tax.
Okay, good to know the clear lines there.
Yeah.
Now, moving beyond the individual entity, the guide gets into the interconnected world of corporate structures, right? Groups, related parties.
Exactly. Tax isn't just a solo game. It's deeply impacted by how groups operate and interact. Remember those reliefs we talked about? Transfers within a qualifying group and business restructuring relief.
Yeah, where there's no immediate tax impact.
Right. But this section details the clawback provisions. If certain conditions change within 2 years, say, The asset transferred within the group is then sold outside the group, or the group structure changes significantly. The original relief can be reversed. Tax implications can arise then. It really encourages stability and genuine long-term restructuring, not just, quick tax maneuvers.
I see. It ensures the relief is used for its intended purpose. And what about dealing with related parties and connected persons? How does the UAE approach that?
The bedrock principle here is the arm's length standard. It's fundamental.
Meaning transactions should be priced as if they were between completely unrelated parties. Market rates.
Precisely. To ensure fairness and prevent artificial profit shifting between related entities, there are disclosure requirements too. If your total related party transactions exceed AED 40 million in a period, you need to disclose them. And payments to connected persons, think directors, owners, their relatives over AED 500,000 also require disclosure and might be adjusted if they aren't demonstrably at arm's length.
So transparency and market value are key.
Absolutely. Then there's another vital rule highlighted. Interest capping.
Okay, limiting interest deductions.
Exactly. The general interest deduction limitation rule caps how much net interest expenditure you can deduct. Net means interest expense minus interest income. The cap is the higher of either AED 12 million or 30% of the taxable person's accounting EBITDA.
EBITDA. Earnings before interest, taxes, depreciation, and amortization. A measure of operating profit.
That's the one. This rule essentially stops companies from using excessive debt, maybe from related parties, to artificially strip profits out and reduce their taxable income. Any disallowed interest isn't necessarily lost forever, though. It can be carried forward for up to 10 tax periods.
Are there exemptions to this interest cap?
Yes, notably banks, insurance providers, and natural persons conducting business are generally exempt, unless they're part of a tax group or the group itself doesn't qualify for exemption. There's also a more specific interest deduction limitation rule just for interest on loans from related parties used for non-business things, like funding dividends.
Complex, but aimed at preventing specific avoidance tactics. What about investment funds?
Right. If you're an investor in a qualifying investment fund, the guide clarifies how you need to include your proportional share of that fund's net income in your own taxable income. And it needs to be broken down into categories: interest, rental, exempt income, other income. It's all about transparency and ensuring the income is taxed appropriately at the investor level.
Makes sense. Okay, so after all those adjustments, the specific rules for groups, parties, interest, we finally arrive at the taxable income, the bottom line number.
That's it, the number that ultimately determines your corporate tax liability.
And for most businesses, income over AED 375,000 gets taxed at 9%. But there's that crucial exception for qualifying free zone persons.
Correct. Their qualifying income gets that very attractive 0% rate, a significant benefit, as you say.
Now, a key question for many businesses, especially new ones or those in fluctuating industries. What about losses? If your deductions exceed your income?
That's what we call a tax loss. And the good news is, generally, you can carry these losses forward. You can use them to offset future taxable income for up to, well, potentially indefinitely. But the offset in any single year is capped. Generally, you can offset up to 75% of your taxable income in a subsequent period using carried forward losses.
So you can reduce future tax bills if you had a tough year. Are there conditions?
Oh, yes, there are crucial conditions, particularly around significant changes in ownership, if more than 50% of the ownership changes compared to when the loss was incurred, and also around business continuity, whether the business continues the same or a similar activity. If both ownership changes and the business activity changes significantly, the loss carry forward might be restricted.
Ah, so rules to prevent people just buying companies solely for their tax losses.
Exactly. Unless the company's shares are listed on a recognized stock exchange or it's a natural person, those restrictions don't usually apply then.
Okay. And for tax groups, special rules for losses within the group.
Yes, the guide details how losses are managed and utilized across the group. It's a carefully balanced system to ensure fair application within the consolidated group context.
Right. One last piece here seems to be foreign tax credits, if you've paid tax abroad.
Yes, a vital mechanism to avoid double taxation on foreign source income. If you've paid foreign tax on income that's also subject to UAE corporate tax, you can claim a credit. This credit reduces your UAE corporate tax liability. But, and this is a key detail, the credit is limited.
Limited how?
It's capped at the amount of UAE corporate tax that is actually due on that specific foreign income. You can't claim more credit than the UAE tax payable on that income. And, very importantly, any unutilized credit, any foreign tax paid that exceeds the UAE tax cap for that income cannot be carried forward or back.
So it's a use it or lose it situation for that specific tax period.
Precisely. Use it or lose it for that period.
Okay, so wrapping this all up, what does this mean for you, the listener? We've journeyed through the complexities of the UAE corporate tax return, from figuring out your taxable person type, making those crucial elections, understanding all the detailed accounting adjustments, dealing with related parties, managing losses and credits. It's clearly a nuanced system. Comprehensive, yes, but definitely designed to be tailored to different business structures and situations.
Absolutely. And if we zoom out, connect this to the bigger picture, the guide really hammers home the need for a meticulous self-assessment process and the absolute importance of accurate, thorough record keeping. All those various schedules, the disclosure requirements we touched on, they really highlight the level of detail the Federal Tax Authority expects. It's all geared towards transparency and compliance.
Well, that's it for this deep dive into UAE corporate tax returns. It's certainly clear that while the overall framework is set, the specifics of your situation, your business type, your structure, your transactions will heavily influence your journey through the return. We really hope this has given you a clearer map, maybe some surprising facts, and more confidence to navigate this important financial landscape.
And perhaps to leave you with a thought. Considering all these specific elections, adjustments, reliefs, and limitations we've discussed, how might proactively understanding them empower you to not just comply, which is essential, but to actually optimize your business's tax position within the UAE's framework? Could it reveal new avenues for efficiency, maybe even growth that you hadn't considered before?